2,000 points. 2 weeks. Here is what happened. Hi, welcome. 2,000 points. Gone. In just 2 weeks. Nifty 50 was trading at 25,180 on 27th February. By 13th March it had fallen to 23,170. That is one of the sharpest 2-week falls we have seen in a long time. Every trader in India is asking the same question right now. What just happened? In this video, I am going to show you exactly that. Day by day. Using the actual charts from each session. Every level. Every signal. Every move. All of it was visible on the charts if you knew how to read them. Let us start from the very beginning. At individual days, let me show you the weekly chart first. Because context matters. Think of the weekly chart like a satellite view. When you are stuck in traffic on the ground, you cannot see the full picture. But from a satellite, you can see exactly where the traffic started, where it is going, and where it ends. This is Nifty 50 from a satellite view, going all the way back to 2021. 5 years of market history in one chart. Look at the structure. To complete market cycles, each one a wave of selling followed by recovery. The pink zigzag lines connect the peaks and troughs. The market has always moved in waves. It always will. Now look at where the current Selloff sits. Current price is around 23,170. Now zoom out even further. The long-term uptrend channel, the blue parallel lines, is still intact. We are still inside it. This 2,000-point fall is significant, but within the bigger picture it is a correction, not a collapse. This weekly view is your anchor for everything I am about to show you. Keep it in mind as we now go day by day. Let me take you back to the our chart covering late February and early March. This is where the story starts. See these two parallel channels drawn on the chart? Think of them like tram lines on a road. Market had been traveling inside these tram lines for weeks, bouncing between the top and bottom lines in a very orderly way. On 2nd March, look at what happened. Nifty opened right at the channel support around 24,800. The pink highlighted candle on the right confirms it. Market opened and closed around the same level. Buyers stepped in exactly where the channel said they should. And further down, respected parallel channel low on 4th of March, another pink circle. The tram lines were working perfectly across multiple days. This is the most important thing to understand about price action. The market respects structure. It does not move randomly. These channels were drawn in advance, and price respected them exactly. Now let us zoom into 2nd March on the 5-minute chart, like switching from satellite view to street view. Market opened strong. A big green candle right at the open. Lots of buyers jumped in seeing that strong candle, thinking the market was going higher. But then, look at what happened next. A slow descending channel formed. Candle by candle, price drifted lower, stopping out every buyer who bought that opening candle. The annotation says it perfectly. Stopped out all the buyers entered by seeing the strong candle on open. This is one of the most common traps in intraday trading. A strong opening candle gets everyone excited. Then the market slowly reverses and stops them all out. But here's the good part. At the day low, buyers stepped back in. Price respected the low and recovered all the way to the intraday channel high by the close. Even on a tricky day like this, the chart showed exactly where to expect support and where the recovery would stop. Nothing was random. Tuesday, 3rd March was a holiday. Wednesday, 4th March, market opened lower with a gap down into the 24,300 to 24,400 zone. Now here is a concept that sounds simple but is incredibly powerful. When a support level breaks, it becomes resistance. Think of it like this. Imagine a glass ceiling in a building. Once you break through it from below, it becomes the floor of the next level. You cannot easily go back through it from above. That is exactly what happened on 4th March. The support level from 2nd March, around 24,600, had now become a ceiling. Look at the annotation. Market reached and respected the support on 2nd March, converted to resistance due to gap down open on 4th of March. Market tried to push above that level, got close, and sellers pushed it straight back down. But notice something, at the bottom of the chart, the 1-hour parallel channel support was still holding at 24,400. The annotation confirms base respected at 24,400, which is according to the 1-hour parallel channel. Even after a gap down, the bigger structure was still working. 2 days in, and the chart was already telling a very clear story. Now this is my favorite day from the entire period, because 5th March is the perfect example of why you should never assume what the market will do next. Look at this chart. All morning, market moved quietly inside a channel. Small candles, slow drift, nothing exciting. Most traders were expecting the market to continue lower. Then, point 2 on the chart, a sudden breakdown. Price fell below the lower channel line into the 1st-hour support zone. At this point, most traders thought, this is it. The market is breaking down. Time to sell. But look at point 3, the support zone held. Buyers stepped in exactly at the right level. And then point 4, the most dramatic moment of the entire 2 weeks. The annotation says, channel breakdown area, where price was expected to complete the retracement and continue the down move, but the same did not happen and gave a blasting up move. A massive green candle. Then another. Then another. 300 points straight up in what felt like minutes. And where did it stop? The annotation at the top tells you. On the sudden up move, market reached the point to fill the gap left on 2nd March and calm down. Price went exactly to fill the gap from 2nd March. Hit it almost to the point and then calm down. This is pure price action at work. The chart had a target. It reached it. And then it stopped. The lesson: never assume. Never fight the chart. Always wait for confirmation before deciding what the market will do next. If 5th March showed unexpected strength, 6th March showed one of the most frustrating things that can happen to a trader: a fake breakout. Let me explain what a fake breakout is with a simple analogy. Imagine a crowded room with a door. Everyone is pushing towards the door, trying to get out. The door opens slightly, people rush forward, and then it slams shut. Everyone who rushed is now stuck. That is exactly what happened on 6th March. Look at the chart. Previous day support zones 1 and 2 are marked on the left. Market spent most of the day hovering near these levels. The annotation says, tempted buyers, and for most of the time it appeared like taking support from previous day support zones. Buyers kept stepping in thinking support would hold. Then at around 2:25 p.m., look at the pink circle on the right. Price briefly broke above the resistance zone. It looked like a real breakout. Buyers rushed in. The annotation is honest. Tempted breakout and faked it and sold immediately. I got caught here too. And then, sharp selling. Channel breakdown. Market closed near the lows at 24,469. The warning sign was on the chart the whole time. The breakout candle had a long wick above resistance and a weak close. A real breakout closes strongly above resistance with a full-bodied candle. A fake breakout just touches the level with a wick and pulls back immediately. Even experienced traders get caught in these. The key is to cut the loss quickly and not let it run. After the sell-off of 6th March, the market continued lower into the following week. By 9th March, Nifty had fallen all the way to the 23,600 to 23,800 zone, a level we had identified on the weekly chart as significant support. Think of this zone like a strong wall. The market had been selling off for a week. Now it hit this wall, and the wall held. Look at the chart. Market gap down to 23,691 at the open, right into the support zone. Multiple channels converging at the open, price looking for a base. And then, buyers stepped in. Strongly. Market recovered from 23,691 all the way to 24,007 by the close. A 300 plus point recovery in a single session from the exact support zone the weekly chart had identified. This is the power of support levels identified on higher time frames. They work, even days later, even after significant selling. 10th March was expiry day, the Tuesday when weekly options expire. Expiry days can be volatile and unpredictable. Market opened gap up, but sold off immediately. Traders were nervous. Would the support hold again? Look at the structure that formed during the day. Higher high, higher low, higher high, higher low. A clean uptrend structure building inside a rising channel all day long. 2 higher highs and 2 higher lows clearly marked on the chart. Market closed at 24,286. Support held for the second consecutive session. When a support level holds twice in a row, that tells you there is real buying interest at that level. It is not an accident. Real money is defending it. Then came 11th March, and everything changed. Look at this chart. The annotation says, broken previous day parallel channel here. You can see the exact pink circled candle where the channel broke in the morning. And then, one of the cleanest sell-off charts you will ever see. The annotation describes it perfectly. One-way slide to 23,850 with no bounce at any point. From 10:15 a.m. onwards, a clean descending channel. No bounces. No hesitation. Just red candle after red candle, all the way from 24,280 down to 23,848. A 380-point fall in a single session. But here is something important to notice. Even in this sell-off, the market was moving inside a channel. The selling was controlled and orderly, not panic. Professional sellers were in control, taking their time, not rushing. When selling is controlled like this, it often means more selling is coming. Panic sell-offs tend to end quickly. Controlled sell-offs tend to continue. Market closed at 23,848, right back at the support zone. Test incoming. 12th March was the most complete story of the entire period, all in one session. Think of it like a boxing match. Buyers came out fighting, built a proper structure, landed some good punches, and then sellers came back and knocked them down in the final round. Market opened gap down at 23,690, breaking below Monday's low right at the open. First the dip to 23,550. Then something encouraging happened. Buyers stepped in. A clean higher high higher low structure started forming inside a rising channel. First higher low at 23,550. First higher high at 23,760. Second higher low respected, HL respected on the chart. Second higher high at 23,840, exactly at the channel high target. For a moment, it genuinely looked like the bottom was in. The structure was clean. The target was reached. Buyers seemed in control. Then the knockout punch. Channel broken. The previous higher low broken, HL broken here on the chart. Strong red candles. Market fell back to close at 23,639. The buyers fought hard. They built a real structure. They reached their target. And sellers were still stronger. This was the chart telling you, the selling pressure is not done yet. 13th March was the day that confirmed everything. Remember 23,500, the level we had been watching all week? The level that had held multiple times? The line in the sand? Today it broke. Right at the open. No fight. No attempt to recover it. Here is the most telling number from today. The high of the entire session was 23,490. Made in the first few minutes of trading. After that, one direction only. Look at the chart. Lower high, lower low, lower high, lower low. All day long. Every single bounce was sold into immediately. No level held. No buyer could sustain any recovery. The annotation says, opened below 23,500 which was a great support so far. That one fact set the tone for the entire session. The only attempt at recovery came around 2 p.m. A small base formation appeared. Price tried to push higher, but the annotation tells the story. Price failed while trying to break lower high around 23,250. Could not even break a lower high. That is how weak the buying was. Market closed at 23,170. A fall of 370 points from the high of the day to the low. From 25,180 on 27th February to 23,170 on 13th March. That is 2,000 points. In 2 weeks. Let us go back to the satellite view, the weekly chart, and answer the question everyone is asking. Where does Nifty go from here? We have now seen every session, day by day, every channel, every support, every fake breakout, every failed recovery. The chart told us the story at every step. So what is it telling us now? Right now price is at 23,170. The 23,500 level that held for 2 weeks has now broken. That is significant. To scenarios from here. Scenario 1, recovery. For buyers to have any chance, Nifty needs to close above 23,500 on the daily chart. Not touch it intraday. Close above it. That is the minimum requirement. If that happens, the first target is 24,200 to 24,500. Beyond that, 25,000 becomes possible. Scenario 2, more downside. If 23,500 is not reclaimed, the next meaningful support on the weekly chart is around 22,000. And the worst case scenario based on the long-term channel structure is 21,500 to 22,000. This is not a prediction. This is what the chart structure shows as the next major level if selling continues. Which scenario plays out depends entirely on what buyers do at current levels. The chart will tell you. It always does. We trade probability, not certainty. Identify your levels. Manage your risk. Let the chart guide every decision. This is the same chart you saw at the very beginning of this video. But now you know the story behind every single candle in that pink oval. Every gap down had a reason. Every bounce had a structure. Every breakdown had a warning sign visible on the chart before it happened. 2,000 points. 2 weeks. Every move explained by price action. This is why reading charts matters. Not to predict the news. Not to know what happens next. But to understand what is happening right now and navigate it with confidence. If you found this useful, subscribe to Nifty Pulse. Every single trading day, I break down exactly what the Nifty 50 chart is telling us, so you are never caught off guard. Drop your view in the comments. Do you think 23,500 gets reclaimed or does Nifty head lower from here? I read every single comment. Trade safe. Thank you.